Welcome everyone. This is Virginia Webinars. In this webinar, we'll be talking about the 3 pillars of finance. My name is Ayman Sadiq. You can see a brief bio on the screen. You can visit viftraining.com for a detailed bio. Joining me in this webinar, my colleague and a financial consultant with Virginia Institute of Finance, Farid Saadi. Farid will be moderating the Q&A, the questions and answers session. Hello, Farid.
Hi, Ayman. Thank you for having me.
Thank you. So during this webinar, we will have small stops where we will take your questions, and feel free to ask any questions related to this topic. Some housekeeping issues before we get started. This webinar is being recorded. At the end, you will receive a link to this webinar and feel free to share it with your colleagues. You can also always go to elearning.viftraining.com for this webinar and all other webinars where you can view them clearly free of charge. Ask away. It is important that we have an engaged session. Ask questions that pertains to finance. We'll be more than happy to answer. We have a 1-minute survey at the end of this event. And for more information on courses, virtual learning, webinars, e-learning, please visit viftraining.com. I do want to start this by asking a question. There's a poll that I'd like you to answer. So here we go. I'm launching the poll now, and it has to do with I know finance. And these are the results. So about half they know about finance, but they want to take this as a refresher. Okay, let's move on. So with the housekeeping behind us, let's take a look at this. Now, we want to understand what finance is. And for us to be able to achieve that objective, it is imperative for us to understand accounting. Accounting is fundamental for finance professionals to understand what finance is all about. So I'm going to spend a couple of minutes on just accounting and what accounting does. We kind of look at finance as the big brother in that portfolio of finance and accounting. So let's take a look at this. So what is accounting? Accounting is simply defined as 2 words: recording and reporting. So an accountant or people working in accounting would record transactions using what we call debits and credits. Debits and credits are pretty much technical jargon accountants understand. In accounting, every single transaction that hits the books or that happens to a company must be either debited or credited. There are 7 rules of debits and credits, which we don't get into it because it's a bit technical. And there are what we call 10 accounting principles that every accountant needs to understand. So once they finish that reporting process, and the reporting process is an ongoing process, it's a never-ending process. And there are companies that will go through hundreds of thousands of transactions on a daily, weekly, monthly basis. Once we finish that process, then we move on to what we call reporting. So now the data has been recorded in the system. Then what do I do with it? I need to report on it. Now worldwide, there are 2 types of reports. There are what we call the financial reports and everything else reports. And the financial reports are pretty much defined in the metric that we use. These are defined by IFRS and GAAP. IFRS being the International Financial Reporting Standards, and GAAP is Generally Accepted Accounting Principles. These rules identify and manage and govern the relationship between the debits and credits and how do they show up on the reports. Specifically when we're talking about financial reports. And these financial reports are really 4 reports, which I will cover in the next slide. But everything else reports are really everything else. Budget reports are everything else report. Management reports, high-level reports, detailed reports. If it is not one of the 4 financial reports, it is considered everything else report. And those are governed by you. Those are governed by your policies, your procedures, and what your management wants. There are no rules there, really. You can design whatever reports that you like. But when it comes to financial reports, these must follow either IFRS or GAAP. So now the financial reports that we're talking about, there are 4 financial reports, and to summarize them is the income statement. And what is the income statement? Income statement has to do with anything and everything related to revenues and expenses that happens in the business, and that can be measured and accounted for. It must be recorded on the income statement. Once we finish the income statement, we move on to what we call the equity statement. And the equity statement has to do with transactions related to the owners of the business. And these could be something like investing in company shares, going IPO, working with preferred shares, common shares, seasonal offerings, dividends, things that has to do with the owners of the business. Once we finish that, then we produce what we call the balance sheet. And the balance sheet has to do with what the company owns, what do they owe, and what is the net balance, which is really the assets minus liabilities, which is called the equity. And in that equity is kind of a summarized version of the statement on top, which is the equity statement. So the result of the equity statement will really show up as specific items on the balance sheet under the equity section. Once we finish that, then we move on to the cash flow statement. Cash flow statement shows only cash in and cash out. And the 4 statements are fundamental in understanding any business and fundamental in understanding finance. As you will see, finance will depend on these financial statements. So this is financial reporting. So what we moved on, we started with recording transactions using debits and credits. Then we moved on to reporting on these debits and credits. We've took all these millions of data pieces, we put them together through the IFRS and GAAP, and we put them on the financial statements. So what is finance then? So we've talked about accounting, that's accounting. So what is finance? Now finance also can be summarized in 2 important words. The first one has to do with analysis. You have data that you have summarized onto financial statements, and you're gonna take these financial statements and do something with them. This something with them is what we're talking about here, the analysis of financial statements. For that matter, the analysis can be approached from different levels. You can do a very top level, high level economic analysis or country analysis. You can do industry analysis, or you can do financial statement analysis. Once we do the analysis, because the data is there, they've been summarized into reports, I'm going to take these reports, I'm going to analyze them. And then once I do that, then I need to make decisions. And that is the heart of this webinar. The decisions that are made in finance are 3 decisions, and that's what we call them, the 3 pillars of finance. To that, I am going to ask you to help me fill in this poll. What are these 3 pillars of finance? So you can see about 61% believe that the 3 pillars of finance is cash, expense, and revenue. And about 22% think it's a finance, accounting, and audit. And 17% says none of the above, choose me. So to that, the answer is none of the above, choose me. And the reason for that is as follows. So let me take you through this storytelling of the 3 pillars of finance. Now, if you start any business, you want to make decisions. The first decision that you would probably make before starting a business is something that has to do with, where do I get the money from? Where do I get the money from is a financing decision. That is a cornerstone in finance. Trying to fund the investment or trying to fund the project or the business plan or the company needs an answer. Where do you finance your project? You can either finance it using debt. Debt are things that I owe the money to you. Things that I will always be obligated to pay back to you. Or I can say I'd like to finance using equity. You own the company with me. And there are none others. Financing decision has to do with either financing a company or a project using debt or equity. Now, each and every one of these has its own characteristics. For example, in debt, I own nothing in the company, in this new venture. I own nothing, but the company is obligated to pay back my money, and on top of that, some kind of interest rate or profit rate, depending if you are doing a conventional finance project or Islamic finance project. The equity side, I am going to be part of this business, and I'm going to fund this business, but there is no obligation whatsoever on the owners of the business or on the company for that matter, because it is a separate entity from the owners. There are no obligations from the entity to pay you back anything. So that's your kind of pros and cons. Do I fund somebody and have them obligated to pay back to me, or do I become partner in something but there is no guarantee that they will pay me back? Each one of these has its own risk and return comparison, if you will. That's what finance is all about. It's about the relationship between the risk and return. So if I want to finance using debt, what would be the sources for me to finance through debt? There's a couple of examples. I can do short-term loans. I can go to the bank. I can tell the bank I need a 3 months, overdraft, line of credit, or a loan, short-term loan. Anytime you hear short-term, you're talking about less than a year. Long term, more than a year. So you go to the bank, say I'd like a loan for 10 years, and that's what you do. Or you can actually issue bonds. Bonds are kind of IOU. When on a personal level, a friend of yours comes to you and says, can you give me 10,000? Say, yeah, sure. I want you to sign this paper. They give you the 10,000 and then you give them an IOU. Well, the same thing, bond, but this is for corporate or for governments, where a company issues a bond. That bond is actually rated by one of the top rating companies, maybe Standard & Poor's, Fitch, or Moody's, and they say you are AAA rating, top rating. That means you have very little risk of not giving back the money to whoever gave you the money. So you issue this paper, you collect the cash. On this paper is a promise that you will give back your money plus some interest. Or sukuk, and sukuk really is the Islamic part, is the Sharia compliant bond. We don't call it a bond, but it is called sukuk. It behaves the same as bond, but with Sharia compliant rules. So these are kind of important and very popular sources of funding when you want to go to debt. If you want to go to equity, how would I finance any new project, a new company? I have a new idea. I need to get money. Well, you can do what we call new shares, maybe an IPO. You have your own private company, and you've grown big enough. You want to collect, multiples of your existing cash or your existing equity. So you go public. You go to the stock market. You fill in certain required applications and paperwork, and then you go IPO, initial public offering or invitation for public offering, and then you would have millions of people sharing the company with you. They'll give you the cash, they'll be part owners, everybody has their own percentage of that company. Or you can do what we call seasonal offering. Maybe after you go IPO, and maybe after 5 years you want to do a big project, you want extra cash, maybe you will work out what we call a seasonal offering. Another part of financing an equity venture or a project maybe venture capital, VC, or some also known as private equity. So venture capital, private equity, those are individuals that will give you their money. They'll become partners with you, and they might be, you're the entrepreneur, you have an idea, they like your idea, they come in with a share of your equity. They might help you in the policies and the procedure, in the guidance, in their expertise. You're the entrepreneur, you want to run the business, but you want some cash, so that's what we do. We do VC or PE. Now, venture capital are primarily for new, very exotic ideas, hasn't been tested in the market, so the risk is very high. Private equity may be funds for ongoing business, but you want to expand that business. A third source of financing your equity or financing through equity is what we call retained earnings. Those are the carry forward profits from prior years. So let's suppose this year I've been doing business on my own. I have generated X amount of net income. Let's suppose I collected on all that net income. I have that cash. That cash, if I don't use it in this year, is carried forward for next year as retained earnings. I still have that cash. Next year, if something comes up that I wanted to expand, I want to do something, I required cash, maybe I can use retained earnings. The issue of debt financing and equity financing is a major topic for companies as they grow bigger. And the reason for that is because I would like to quantify that decision making. When I say I am making a decision and I'm making that decision through debt or equity, what would be the best combination? Why would I not use only debt? Why would I not use only equity? Can I use a combination of this? And the answer is the answer here is really to come up with a quantification, monetization of the decision making. The decision making is a qualitative, if you will, decision, but it needs to be monetized. Using what? In the financing decision, it is in using interest rate. So the decision, the financing decision making is translated into interest rate, and in finance we call it the weighted average cost of capital. It's the weighted average cost of capital. Why do we call weighted average cost of capital? Because it is a weight between debt and equity. I may need 100 million, 30% financed through debt, 70% through equity. Debt has its own cost, equity has its own cost, then I'll come up with the weighted average cost of capital. It's a fundamental metric in financing decisions. Companies, as they go bigger, overall, they have what we call a weighted average cost of capital. So if they want to get into any project and the project is returning, for example, 10%, and they know that their weighted average cost of capital is 5% or 8% or 9%, it will give them guidance as to should we go or no go with this new project, as you will see in the next few slides. So the first decision that we made in finance, or the first pillar in finance, is actually making financing decisions, and those are separated between debt and equity, and then we need to monetize them using what we call the interest rate, which is effectively the weighted average cost of capital. These are examples of financing decisions. Anything that has to do with debt funding or anything that has to do with the equity funding is considered a financing decision. I'll give you a second to take a look at this. Okay, so let's move on to the second decision, and the second decision has to do with, if you can guess that, has to do with investing decisions. So now I had an idea, I have an idea, I need to fund it. We've answered that question. Now I have the funds. What do I do with funds? I could do one of two things. I could either invest internally or externally. This is the second pillar in finance, investing decisions or investment decisions. So when you want to invest internally, what does that really mean? Investing internally means I would like to grow my core business. I am in the airline business, I buy more planes. I am in the car rental business, I buy more cars. I'm in real estate business, I buy or build more buildings and houses and condos and related to that business. That is investing in core business. The second decision has to do with external decisions, external investing decisions. And external investing decisions breaks up really into two summarized kind of high-level decisions. One is called just general financial investment. You're a company, you have extra cash. What do you do with this cash? I can decide to keep that cash in the business. So if I want to keep it in the business, that's fine. You can keep it in cash. You might as well take that cash and invest it. You'll make more money. In conventional finance, in Sharia compliant finance, but you'll be able to utilize that money. So if you put it at the bank, maybe you'll get 1 or 2%. Nowadays, the Fed rate is almost zero, if not zero. For the next 2 years, it's going to be zero. And if I put my money there, I'm going to earn zero. I'd rather take that money because that's excess cash for me. I'm going to go into another business. Maybe I'll invest in something that will yield me more return. So that's the financial investment. But I also can say I have excess cash, but I want to do mergers and acquisitions, M&As. I want to do buyouts. I want to buy other companies or part of other companies. So I can go horizontally. Horizontally means what? If I'm in the airline business, I go buy another airline business. I'm in the courier business, I buy another courier business. Amazon, bought Souk.com. Souk.com is a company established in the UAE. So Souk.ae. Amazon is in this business, it bought Souk.com, and it's horizontal mergers. Vertical mergers. Something that there are things that has to do with the supply chain. So for example, an airline business might purchase a food catering business. They distribute millions of meals every day on the planes. So if they buy a catering business that provides this, the food business, that will help the company materialize more margins and profits for that matter. Or I can decide I have extra cash. I would like to buy another company not in the same line of business. And that, begs an important question. Why would I do second pillar of finance, an investment decision? Why would I do internal investment rather than external investment, and vice versa? What would be the reasons? They're clear in front of you. If I want to grow my business, I am going core business, I'm going to do internal investment. Does that mean that external investing is not growing? Of course you're going to grow. But the objective of external investing is not about growing your core business. It is about diversification, diversifying your risk. When you're an airline, you buy another airline, maybe in another country. So you're diversifying, if you will, the country risk for that matter. The same thing applies for vertical and conglomerate. So the objective of external investment is diversification. So when it comes to company management to make decisions on investing, I have made money. What do I do with the money? I need to answer that fundamental question. Investing where? Internally or externally? And that's very important. Now, if I make one of these decisions or both decisions, maybe I have excess cash, I have extra cash, and I say some of it goes into internal and some of it goes to external, as a lot of companies do. How can I quantify that decision making? Why would I say in internal decision, I want to grow the business, but I have 3 business plans? Which one is better for me? And same thing applies if I have external. I have different proposal. Why would I choose proposal 1, not proposal 2? That means in investing decisions, the second pillar of finance, I also need to do what? I also need to convert the investment decision or decisions to a metric. That metric in investment is called NPV and IRR. And NPV is called net present value, and the IRR is the internal rate of return. So if I have multiple projects, and let's suppose I'm doing internal investment, and I've asked the team to give me 3 proposals on how we grow the company from growth point of view, from core business point of view. They gave me 3 proposals. How would I evaluate them? Why would I choose one and not the other? I'm going to say, you know what? Let's apply the net present value process, and it will give me an amount. Based on that amount, I can determine with the factual, if you will, and cemented decisions that this project is better than the other project. IRR supports NPV. So if I want to look at the projects from an internal rate of return, then I want to look at IRR. And why is IRR very important? Because if you look at the first pillar of finance, that's called financing decisions, I was able to convert the financing decision into interest rate. The IRR is also interest rate. And that gives me 2 interest rates that I can perform comparison between them. And this comparison always must be, IRR must be equal or more than the weighted average cost of capital. For the project to yield positive net present value, my IRR must always be higher than weighted average cost of capital, the WACC, or equal to it. So the financing decision becomes an input to the investment decision. I must figure out what is my WACC. I plug it in my calculation of net present value and IRR, and I will come up with NPV and IRR. So NPV is a dollar, is a real, is a dirham metric, is a monetary metric. IRR is a interest rate metric. Now, why do I do NPV? NPV, net present value, gives me an amount. If I have 3 projects and I run the NPV rules on the 3 of them, one produces 1 million, the other produces 5 million, and the third one produces 10 million. Automatically, I would want to select the 10 million. And the reason for that is because the 10 million is the result of all expected future revenues minus all expected future expenses, any kind of expenses in the business, and I will subtract them from each other. I'll come up with the net cash flow for the future years. I will discount them at the WACC rate, weighted average cost of capital rate. If the result is positive and higher than positive, that means this project is a go. It will add to the shareholders' wealth. If the NPV is negative, that means this project will not make its required rate of return. It will not make what I anticipate in making to the shareholders of the business. The IRR is the kind of the other face of the coin for the NPV. Here's why. Let's suppose now I know from a corporate financial management point of view that if I want to borrow any money from anybody, I would actually need to borrow at a weighted average cost of capital of 10%. That means I go to my team and I say, listen, I need you to scout projects. We need to invest in projects. We have extra cash. But you cannot bring me any project that is less than 10%. So they're going to bring me projects. I'm going to run the projects, the NPV and the IRR on the projects. If the IRR on the project is 5%, what does that mean? That means I lose money. The cost is 10%, the return is 5%, I won't make money. So the IRR must be at least equal or more than the weighted average cost of capital. I hope that answers just a little bit of the difference between NPV and IRR. NPV is a money, IRR is an interest rate.
Yes, Ayman, we actually received another question regarding IRR. The question is, some companies use hurdle rates for IRR that differ from their WACC, which are typically higher. What are your thoughts on that?
That's a good question. There has to be, because as I alluded to earlier, the IRR is the internal rate of return. The WACC is the cost of funds that I bring in. I should be, the NPV is defined as what? The NPV is defined as the money that you make in excess of the weighted average cost of capital using your IRR. In other words, if your IRR is equal to your weighted average cost of capital, then your NPV is equal to 0. So my break-even analysis here with regard to the IRR is that if it equals WACC, then I will make no money, but I will lose no money. Why would I go into this business? Maybe those are strategic decisions. It's a new industry that I want to get into. The barrier to entry to this industry is a bit higher, and therefore I'd like to get into that industry, so I'm willing to accept NPV equals 0. That means I've covered all my expenses. I've covered my bonuses. I've covered my salaries. I covered my depreciation, all that stuff. And therefore, company says, I need at least an IRR of 15%. So that's my hurdle rate. Is you cannot come back to me and say, oh, I have projects for you that is 11%. I know 11% is going to make me some money because the WACC is 10%, but it's not, that doesn't cut it for me. I need a little bit more. So at a minimum, I need a 15% IRR. My hurdle rate is 15% for me to be able to cover the WACC and generate some profitability for the shareholders. I hope that sheds some light on that question. So now we've made decision on financing decisions. We've converted it to WACC. We've made investment decisions, internal, external. We know why we're making them. Either I want to grow or I want to diversify. And I can mix and match at my stage, at the life cycle of any business. You probably will focus on growing at the beginning, but then as you kind of plateau with regard to your industry, you start looking outside your industry, and that's where you start doing mergers and acquisitions and go into the external diversification. These are examples of investment decisions. All right, so let's move on. Operating decisions. That's the third pillar. Let me walk you through the story. So you've made a financing decision, you take the money, what do you do with it? Invest internally or externally. Why would I want to do that? Because there's an NPV and IRR. I pick that, I've invested. Now what do? You run the business. So in running the business, at the end of the day, for any business, the end of the day is usually 1 year. And that's why IFRS and GAAP says you need to produce financial statements, annually or periodically. Certain industries might have 18 months of lifespan on the annual report or the financial report. Well, majority of companies are fiscal reports that starts other than January, or calendar report or calendar year that starts in January, ends in December. So throughout this year, you have the money, you invested, now you're running the business. At the end of the day, at the end of the year, you're going to produce 2 important statements, part of the 4 statements. And you need to worry about, in operations, you need to worry about working capital and cash flow. What's the difference? Working capital management. Working capital has to do with your day-to-day use of your business. What do you use in your business? You use your receivables, you use your payables, you use your inventory, you use your cash, your accruals, in and out. You purchase, you manufacture, you sell, you collect, you pay, and that process keeps going on and on throughout the year. That process, working capital, is fundamental. In the third pillar says, what kind of working capital management decisions do I need to run the business with? And there are different levels. There are theories in working capital management, things that has to do with aggressive approach to working capital, or conservative approach or hybrid approach. Each one has its own characteristics on how do you work, how do you run the business, and where do you finance that part of the working capital from. The second part of running the business is just not running the operations. It is actually, what do you do with your cash? You have cash in, you have cash out. How do you manage that? To answer these two questions, or the translation is to quantify these decisions that you've made on working capital and cash flow. At the end of the year, you must produce two financial statements. One is called income statement and the other one is cash flow. Working capital decisions, so whatever you do with working capital will be translated on the income statement in the form of sales, cost of sale, and operating expenses. And we call this money on paper. And then we look at the cash flow, and the cash flow will be translated into a statement called cash flow statement. And we call this money on hand. And I would like to ask you a question before I move on here. And that question has to do with, if you were to pick only one statement to be the most important statement for you, and only one, would it be income statement or will it be the cash flow statement? So can you please answer that? Thank you. Here are the answers. So 65% believe cash flow is the answer, and 35% think that's the income statement. And I could have not agreed more than the cash flow statement. Cash flow statements is fundamental in the business. Income statement is extremely important, but cash flow is more important. The challenge here is as follows. You're running a business, and as you run the business, you will issue receivables and you will collect on the receivables. And that's when we're running the business, we record the revenues and we record the expenses. When we receive the cash or we pay the cash, that is called the cash in, cash out. What's the difference between income statement and cash flow? And what's the difference between income statement, balance sheet, equity statement, those three statements, and cash flow? Accounting rules, IFRS and GAAP says, when a transaction happens, you must record it, regardless of did you receive cash or pay cash. And that is called the accrual basis of accounting, نظام الاستحقاق في المحاسبة. Across the world, the IFRS and GAAP says when things happen, record it, not when you receive or pay cash. So when I deliver a service, I'm going to record that revenue has taken place. I haven't received a single dime from that sale. It matters not. And then I'm going to record the expenses associated with it. So on the income statement, I'm going to show the revenues, I'm going to show the expenses. How much of that do I have in cash? Probably nothing until I start collecting. And that's the income statement. So that's why we say income statement is money on paper. It's hypothetical money. It's, yeah, I have 100 million in net income. That's great. Can you pay salaries? No, I don't have, we don't have cash to pay salary. Oh, but but we have net income, 100 million. Can you pay rent? No, we can't pay rent. We don't have cash, but we have 100 million in net income. The cash flow statements on the other side says, I will only record cash in and cash out only when I receive cash or I pay cash. So at the end of the day, it is how good I am in managing the business, how good I am in converting the on money paper to money on hand. And that's why cash flow statement is fundamental. The income statement is extremely important, but the cash flow is the most important. It is the weakest link in the financial statements, and it is the weakest link in these three pillars of finance. Financing decisions, investment decisions, and operating decisions.
Ayman, I received a direct question.
Yes.
The question is, so management's goal or job is to increase shareholder value. Don't they do this by increasing sales? Doesn't this make the income statement more important than the cash flow statement?
Absolutely.
Can you elaborate on this?
Well, I agree on the part that says the objective is to maximize shareholders' wealth. Management also want to maximize their bonuses. And that's why in finance we call this the agency theory. It's the agency problem, where the shareholders hired management to maximize the shareholders' wealth, but at the same time management wants to maximize their wealth in lieu of more bonuses. That's why income statement is very important. But at the end of the day, realizing that the income statement is very important, management is going to take money. They're going to do bonuses. They're going to get bonuses because they have higher revenues and lower expenses. But at the end of the day, do you have the cash to run the business? If I don't have policies and procedures managing my current assets very effectively and efficiently, collections of receivables, turnover of inventory very fast, probably I'm not saying delaying the accounts payable, but moderately managing accounts payable. I need to be able to manage the cash flow, because without the cash flow I won't be able to go back and say, oh, we're making lots of money. We're making lots of money on paper, but I need this to be translated into actual cash. I could be signing contracts in hundreds of millions, but I know that, and I record it on my books, which is not accounting. You cannot do that, but companies do that, and that shows that the income statement is very healthy. But when it comes to cash flow, you don't have cash flow to run the business, and that's why companies actually go belly up. They go bust because they can't run the business from the cash flow. So we're not saying that income is not important. It is important. A lot of the financial ratios that we run on the financial analysis is based on the income statement. But I need to realize that the conversion from an income statement to cash flow is fundamental for the continuity of the business. And it's a good question. Okay, so here are examples of operating decisions. Silverjet grounded amid cash flow crisis. The running business. It's a long haul from New York to London. They ran out of business because they could not fund they couldn't find $5 million of funding. It's just the cash. How do you manage cash? It's extremely important. And you can see the scandals with the accounting treatment. You try to beef up your income statement, but you realize you don't have cash, or misaccounting, you window dress, and that way it gets you into trouble. So in the final analysis, I have financing decisions, I have investment decisions, and I have operating decisions. Each one has been quantified. In the financing decisions, I quantify it to weighted average cost of capital. In the investment decision, I quantify it to net present value and internal rate of return. In the operating decision, I really quantify it in how much cash do I have. If you look really at the cash flow statement, you will see that the cash flow statement is structured in a way that relate back to the three pillars of finance. The cash flow statement is structured as cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. So it's telling everybody, all users, by the way, you've made decisions throughout the year, and the result of these decisions has to be transformed into cash, and these are the result of your decisions on the cash flow statement. We take these results and we try to forecast our key performance indicators. We do what-if analysis, scenario analysis, different scenarios, and then we make decisions again. That's why every year we run these reports and we perform these analyses, and we do planning for next year decisions. Any questions? I see a comment says yes. The realization of your success with healthy cash flow. Absolutely, that's right. Now let me take you this. This is kind of the finale of this. We've said that in finance there are three decisions: financing, investing, and operating. And these will transform into these statements: income statement and balance sheet. So the result of the operating, investing, and financing show up on your income statement and on your balance sheet. How do we do that? Here we go. So the operating decisions are always shown on the balance sheet, current assets and current liabilities. That's it. And they're shown on the income statement. So anytime you're thinking operating decisions, look at your current assets, look at your current liability, and look at your income statement. If you want to look at your investment decisions, investing decisions, then go to your non-current assets. Those are the fixed and the intangible assets. Those are the result of the decisions that you've made from an investment point of view. Internal or external, they will show up here. And if you want to figure out what you've been doing with your financing decisions, go to your non-current liabilities and go to your equity. That's where it tells you where are you getting your money from and how are you managing your money. And if you want to say, listen, how am I actually using the cash? Then you go to the cash flow statement. In the cash flow statement says cash flow from operating decisions, cash flow from investing, and cash flow from financing decision. We're a few more minutes. We're at 4:53. So if you have any questions, feel free. So far we've got really important and core questions. Feel free to ask any other questions. If not, I have a poll I would like to share with you. I think it's a nice poll. It has to do with personality styles related to finance people and accounting people. Finance professionals and accounting professionals. So let me share that with you. I want to share that. And the question says, personality styles. Accounting is creative, finance is logical. Accounting uses right side of brain, finance uses left side of brain. Accounting is logical, finance is creative. What do you think? Okay.
Amen. I received a direct question. Yes. I'll go ahead and ask after the poll.
Sure, thank you. Here are the results. So you can see 60% believe that accounting is logical and finance is creative. And I tend to agree with that. Accounting is the left side of the brain. Accounting is the debits and the credit. It must equal. 1 + 1 = 2. In finance, they might argue against that. They say 1 + 1 = 3 because they're going to do mergers and acquisitions and they're going to say, oh, 1 + 1 is equal 3 because there are synergies. But accountants say no. Debits are equal credits. Asset equal liability plus equity. Every transaction must have at least one debit, at least one credit. And they use the left side. Left side of the brain scientifically focuses on logic. Right side of the brain focuses on creativity. That's why finance people are more involved with the analysis. Because the analysis, although they are kind of structured, but the interpretation of them are sky's the limit. How do you structure a deal is creative. But how do you debits and credit? It's known, it's fixed. So 60% says that is the right answer. I appreciate that. You have been great. We are almost an hour, 4 minutes to go to the hour. Farid, you said you have a question?
Yes, I have two questions.
Please.
The first one is the question is asked, do I need to have a degree in finance to project cash flows?
Ooh, tough question. You know, Farid is our subject matter expert in financial modeling and cash flow forecasting. So Farid, if you would like to jump in, feel free, or I can answer that.
Sure.
Okay, please go ahead.
Sure, Ayman, I'd be happy to. So I personally, and Ayman and I have discussed this several times, I don't believe you need to have a degree in finance to project cash flows. As I've as Ayman and I have discussed, all I believe you really need is a logical understanding of the business and the drivers behind the business, as well as a fundamental understanding of accounting. I don't think you need much more than that, um, other than basic logic and real world, or I should say, grounded assumptions.
Well,
Ayman, what do
yeah,
you think?
thank you. Thank you, Farid. The degree is a degree is investment in time and effort and money. And if you want a career in finance, a degree is a must. And nowadays, an undergrad is a bare minimum. You need to do a master's degree, MSF. Farid has an MSF in finance. I have a master's in financial economics. So it is imperative if you want to make this as a career, if you want to go into corporate. But if you want to entertain ideas that are related to cash flow and projection of cash flow, sure, you can do that. You can rely on a bit of reading, you can watch videos, you can consult with friends and families, you can call us, you can email us, and all that stuff. But at the end of the day is what you want to do with that cash. If you're doing a personal projection of cash flow, you want to figure out what, your cash in, your salary, subtract rent and utility and all that stuff. You don't need a degree in finance, but when you want to go into corporate, degree in finance is a must for you. Not to mention that you need to, if you're in corporate, you need to do something in CFA, CPA, and those kind of certification. But just to project cash flow in that context does not require a finance degree, but you can educate yourself to develop basic cash flows, as Farid says, and you can develop them as you go. I hope that answers the question. Is there another question?
Yes, I had a question sent to me directly,
Okay.
and it was asking about the three pillars of finance. How do they relate to this thing called free cash flow?
Free cash flow. So the free cash flow is a process. It is not a concept. Yeah, it is a concept, but it's a process within a managing or working with corporate valuations or cash flows. You see, when you generate revenue, you have incurred expenses. Accrual basis of accounting says if the revenue happened, record it. If the expense happened, record it. And then in running the business, you incur also expenses that has nothing to do with cash, such as depreciation, amortization. The free cash flow principle works under that premise. It is a metric that converts a simple metric that converts your income statement into free cash flow or into cash flow that I can use to build my forecasted plan, discount them, and come up with an NPV and IRR. So you need to think of free cash flow from that concept. It is not a pillar in finance, it is a utility. It's a technique that you apply to make your job easier. If I am external to a business and I want to evaluate this business and I want to do some assumptions on this business, the finance department in that company are not going to give me the details. The only thing they're going to give me, if they're publicly traded, is the financial statements. So how can I calculate the free cash flow on the financial statements? If I don't have the details, then I'm going to do the free cash flow metric. I hope that answered the question. It's a simplified version of a metric allowing you to come up with cash flow. Okay, again, you have been great. Farid, any questions?
No, it looks like we've answered everything.
Thank you,
everyone
everyone.
Another minute or so.
Yep. Thank you. We appreciate it. You can always go to www.viftraining.com. You can email us at courses@viftraining.com. You can, on the website, you will find virtual courses, e-learning, webinars. We have all webinars listed till the end of the year. Just go to the webinar page, register, The process is automated, and they will remind you 24 hours before the webinar starts. And if you have any other questions, feel free to communicate with us. Thank you for staying with us for this hour after work. We hope to work with you on other Virginia webinars. Thank you very much.